Hey everyone, welcome back to my channel and a huge welcome to all of you joining this live stream. I am so pumped to have you here for day 3 of our financial education journey. So if you've been with us since last Friday when we kicked off this incredible series, you already know what we're doing here. But for anyone who's new, welcome! We're diving deep into the fundamentals of finance and capital markets using Khan Academy. Using these free resources online, Khan Academy's amazing free resources. And we're learning together as a community. Let me catch everyone up on where we've been. Last Friday was day 1. On the last Friday, we explored the compound interest basics and the interest fundamentals, right? I want to bring back my notes. As you can see, I hope you can see here. This is my notes since the first time we tried to explore this topic. Last Friday, September 26th, we talked about the compound interest basics, compound interest rule of 72, and where we like how compound interest is like a snowball rolling downhill, and why it's powerful for building your wealth. And then yesterday, which is Sunday, September 28th, 2025, and we tackled credit cards and loans. What a session that was, right? We discovered how credit card companies hide the true cost with their advertised APR versus the effective APR. And then we pulled back the curtain on the entire credit card network and learned how Visa, MasterCard, issuing banks, and acquiring banks all make money from every transaction. And then we exposed the payday loans for what they really are: financial traps charging 650% to over 32,000% interest rates. So now today, here we come, is the day 3. And we're continuing our journey through Unit 1, Interest and Debt on Khan Academy. This is our dashboard, as you can see. We've completed 3 lessons so far, and there's still so much incredible content waiting for us. I am really excited about what we're going to discover together today, because each lesson builds on the previous ones, and you can already feel your financial literacy growing, right? Let me know your thoughts in the chat. So every day we're adding another layer of knowledge that's going to help you make smarter financial decisions for the rest of your life. So get comfortable, grab your coffee or just grab your tea and maybe some snacks. And let's dive right back into Khan Academy. If you haven't subscribed yet, make sure you hit that subscribe button and ring the notification bell so you can join us every morning at 9 a.m. Eastern Time for these educational sessions. Alright, everyone, let's see where we picked up today and continue building this incredible foundation of financial knowledge together. Let's do this! So I can see exactly where we are in our learning journey. Those blue check marks show show all the amazing progress we've made together over the past few days. So let me recap for everyone watching. We've successfully completed 3 major sections under Unit 1, Interest and Debt. So first one, compound interest basics, where we learned how money multiplies over time and that incredible rule of 72, right? Like I just mentioned. And then we talked about the interest basics, where we broke down the difference between simple and compound interest with all those formulas. And then we talked about the credit cards and loans, where we exposed the truth about APR, discovered how the credit card network operates, and learned about those predatory payday loans. Now looking at our dashboard here, we can see what's coming next in Unit 1. We still have several more sections to explore: continuous compound interest and E, present value, and then personal bankruptcy. And I see there are even more topics after that. Unit 2 until the Unit 10. This unit is packed with essential financial knowledge that's going to transform how you think about money and debt. So today, Day 3, we're going to continue moving forward and tackle the next section. The beauty of Khan Academy is that everything builds on what we've already learned. So those compound interest concepts we mastered on Day 1, they are going to help us understand continuous compound today. Continuous compounding. We're gonna talk about the continuous compounding today. And those we have learned on the Day 1, that's really helpful. Are you guys ready to add more powerful financial knowledge to your toolkit? Let's kick on the next section and see what Khan has in store for us. No, not this one. We have finished this part. So we're going to go to this part. This is going to be another eye-opening session. Which section should we dive into first today, everyone? Oh, this one, right? Let's keep this financial education momentum going strong. All right, so as you can see, we have 3 short videos today. We're gonna watch it together. One by one, we will go through each of them. Before we jump into this video, let's read the description together, and I'm going to explain what this mysterious number E is in the simplest way possible. The description says, introduces a very special number in the world of math and beyond, the constant E. Now, I can see some of you might be thinking, wait, what? We're learning about finance and suddenly we're talking about some weird math constant? But trust me, guys, this is going to connect back to everything we've been learning about compound interest. So, what is this number E? Okay, before we start this video, let me give you a brief explanation. Just 1 second, I want to bring back my notes. So we're here, E and compound interest. Continuous compound interest and E. I just want to simply copy and paste it here. Alright. Make it in the center. So let me explain this like you're hearing about it for the very first time. What is a number E? You know how we have famous numbers in math like pi? The pi, yeah, I know, it's very popular and it's very, very famous. That is the pi is about 3. But today we're gonna talk about the E. What is the number E? The pi is about 3.14 and help us calculate circles, right? Remember that guy? Well, E is another one of those special numbers and it's approximately 2.718. But here's why E is so important for what we're learning about finance and interest. Remember when we talked about compound interest? We learned that if you compound interest yearly, you get one amount, right? If you compound monthly, you get a bit more. If you compound daily, you get even more, right? Well, what if, what if, and this is where it gets weird, what if you could compound interest not just daily, not just every hour, not just every minute, but continuously? Like every single tiny fraction of a second non-stop forever? That sounds exciting, right? That's where this number E comes in. So the number E is what you get when you take compounding to the absolute extreme, when you compound it infinitely many times. Think of it like this. Imagine you're cutting a pizza. First you cut it in half, and that's like compounding once, right? And then you cut those halves in half, compounding twice. Then you keep cutting smaller and smaller and smaller pieces. Then what happens? You just keep doing that infinitely. The number E is kind of like the mathematical result when you keep doing that forever with compound interest. So now let's talk about why should we care about E in finance. Why it's so important? Why should we care about it? Because in the real world, some finance calculations actually use continuous compounding. Some investment returns, some bond calculations, and some advanced financial models all use this number E. Continuous compounding. In the many financial calculations, we will use this number E, and investment returns, and I just talk about the bond calculations, and also some advanced financial models, right? So E, basically, E is very important. It is like the ultimate, most extreme version of compound interest. Extreme version of compound interest. So when we watch this video, we're gonna watch this video together. This first one, E and compound interest. So in this video, Salkan is going to show us how this special number E equals 2.718 relates to everything we've been learning about compound interest. It's going to tie together all those concepts from our previous lessons in a really beautiful way. But don't worry if this sounds complicated right now. I just want to give you a brief explanation. Salkan is amazing at making these concepts crystal clear. By the end of this video, you're going to understand why mathematicians and financial experts think this number is so incredibly special. And are you guys ready to discover one of the most important numbers in all of finance and mathematics? So now let's hit that play and let Salkan blow our minds with a constant E. This is going to be fascinating. So stick around.
Let's say that you are desperate for $1, and so you come to me, the local loan shark, and you say, hey, I need to borrow $1 for a year. And I tell you, well, I'm in a good mood. I'm willing to lend you that dollar that you need for a year, and I will lend it to you for the low interest of 100% per year. So 100% per year. So how much would you have to pay me in a year? Well, you're going to have to pay the original principal, what I lent you, plus 100% of that. So plus one other dollar, which is clearly going to be equal to $2. Now, you say, well, gee, that's a lot to have to pay, to have to pay back twice what I borrowed, and there's a possibility that I might have the money in 6 months. What kind of a deal can you get me for that, Mr. Loan Shark? And I say, oh, gee, if you're willing to pay back in 6 months, then I'll just charge you half the interest for half the time. So you borrow $1, and so in 6 months, I will charge you 50% interest. 50% interest over 6 months. This, of course, was one year. And so how much would you have to pay? Well, you would have to pay the original principal, what you borrowed, the $1, plus 50% of that $1. So plus 0.50, and that, of course, is equal to 1.5. So that is equal to, or $1.50. I'll just write it like this, $1.50. Now you say, well, gee, that's, I guess, better, but what happens if I don't have the money then? If I still actually need a year? And I say, well, we actually have a system for that. What I'll do is just say that, okay, you don't have the money for me yet. We can think about it, that I'll just lend that amount that you need for you for another 6 months. So we'll lend that out. We'll lend that out for another 6 months at the same interest rate at 50% for the next 6 months. And so then you'll owe me the principal, $1.50, plus 50% of the principal, plus 75 cents, and that gets us to $2.25. So that equals $2.25. Or another way of thinking about it is to go from $1 over the first period, you just multiply that times 1.5. If you're going to grow something by 50%, you just multiply it times 1.5. And if you're going to grow it by another 50%, you can multiply by 1.5 again. So one way of thinking about it is that 50% interest is the same thing as multiplying by 1.5. So if you start with 1 and multiply by 1.5 twice, this is going to be the same thing. $2.25 is going to be 1 multiplied by 1.5 twice. 1.5 multiplied twice is the same thing as 1.5 squared. And you can see the same thing right over here. This is the same thing. 100% is the same thing as multiplying by 2, as literally multiplying by 1 plus 1. So this is multiplying by 2. So you could view this right over here. You could view this as 1 times 1 to the first 1 times 2, I should say. 1 times 2 to the first power, because you're only doing it over one period, over that year. And you say, hey, once again, where's that 2? Well, if someone's asking for 100%, that means over the period you're going to have to pay twice. You're going to have to pay the principal plus 100%. You're going to have to pay twice what you originally borrowed. If someone's charging you 50%, over every period, you're going to have to pay whatever you borrowed, so that's kind of the one part, plus 50% of it. So 1.5 times what you borrowed. So you multiply times 1.5 every time. And if you wanted to see how this actually related to the interest, you could view this as, so this right over here is equal to 1 times the interest part is 1 plus 100% divided by 1 period to the first power. And I know this seems like a crazy way of just rewriting what we just wrote over here, writing 1 plus 1, but you'll see that we can keep writing this as we compound over different periods. This one right over here, we can rewrite. We can write as 1 times 1 plus 100%. Here we took our 100% for the year and we divided it into two periods, two 6-month periods, each of them at 50%. 1 plus 100% over 2 is the same thing as 1.5. And then we compounded it. We compounded it over 2 periods. And actually, let me do that 2 periods into a different color. So this, the periods, let me do in this orange color right over here. And you might start to see a pattern forming. So let's say, well, gee, maybe I have the money back in, and you don't really like this because this is $2.25. That was more than the original $2. So you say, well, what if we do this over every 12 months? I say, sure, we got a program for that. So after every 12 months, after every month, I should say, I'm just going to charge you, 100% divided by 12 interest. So this is equal to 8 1/3%. And taking having to pay back the principal plus 8 1/3%, that's the same thing as multiplying times 1.083 repeating. So after 1 month, you would have to pay 1.083 repeating. After 2 months, and this isn't to scale, that actually looks more like more than 2 months, but it's not completely at scale. After 2 months, you're going to have to multiply by this again. So times 1.083 repeating. And so that would get you to 1.083 repeating squared. And if you went all the way down 12 months, so let me get myself some space here. So if you went all the way down 12 months, so 12 months, or I should say from the beginning 12 months, so another 10 months. So what's the total interest you would have to pay over a year if you weren't able to keep coming up with the money, if you had to keep reborrowing and I kept compounding that interest? Well, you're going to have to pay 1.083 to the, well, this is for 1 month, so you could view this as to the first power. This is for 2 months, so you're going to have to pay this to the 12th power. We have compounded over 12 periods, 8 1/3% over 12 periods. Or if you wanted to write it in this form right over here, this would be the same thing as our original principal times 1 plus 100% divided by 12. So now we've divided our 100% into 12 periods, and we're going to compound that 12 times. So we're going to take that to the 12th power. So what is this going to equal to, this business right over here? So we can get a calculator out for that. So get my TI-85 out. And so what is this going to be equal to? Well, we could do it a couple of ways. And this is 1.083. Let me actually, this is repeating right over here. Let's get our calculator out. So we could do it a couple of ways. Actually, let me just write it this way. You're going to get the same value. And I don't have to rewrite this one here. I just did that there to kind of, hopefully you see this, the kind of the structure in this expression. So 1 plus 100% is the same thing as 1. So 1 divided by 12 to the 12th power. To the 12th power. 2.613, I'll just round. So approximately 2.613. Now you say, well, this is an interesting game. You've almost forgot about your financial troubles, and you're just intrigued by what happens if we keep going this. If we, here we compounded we have 100% over a year. Here we do 50% every 6 months. Here we do a 12th of 100%, 8 1/3% every 12 months, and we get to this number. Well, what happens if we did it every day? Every day. So if I borrowed $1, and I said, well, gee, each day, I'm just going to charge you 1/365th of 100%. So 100% divided by 365, and I'm going to compound that 365 times. And so you're curious mathematically, and you say, well, what do we get then? What do we get? What do we get after a year? Well, you have your original principal. Let me scroll over a little bit more to the right so we have more space. You're going to have your original principal times 1 plus 100% divided by not 12. Now we've divided the 100% into 365 periods. 365 periods. But we're going to compound it. Remember, every time we have to multiply by 1 plus 100% over 365 every day that the loan is not paid. So the 365th 365th power. And you say, oh, gee, taking something to the 365th power, that's going to give me some huge number. But then you say, well, actually, maybe not so bad, because 100% divided by 365 is going to be a small number. This thing's going to be reasonably close to 1. And obviously, we could raise 1 to whatever power we want, and we don't get anything crazy. So let's see where this one goes. Let's see where this one goes. So this is the same thing as 1 plus 100% is the same thing as 1 divided by 365 to the 365th power. And we get 2.71456. Let me put it over here. So then we get, so this is approximately equal to 2, and this approximate is a very, it's a very precise approximation, but 2.7, but my calculator's precision is only goes so far, 2.714565, and it keeps going on and on. And this is really, really interesting. It looks like as we take larger and larger numbers here, it doesn't just balloon into just some crazy, ginormous number. It seems to be approaching some magical and mystical number. And it is, in fact, the case that if you were to just take larger and larger, if you were to take your 100% and divide by larger and larger numbers, but take it to that power, you're going to approach perhaps the most magical and mystical number of all, the number E. And you could see it right over here on your calculator. They have this e to the x, and I can do that. So e to the, I'll raise it to the first power so you can look at the calculator's internal representation of it. And you see just already raising doing 1 plus 1 over 365 to the 365th power, we're starting to get really, 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 really close to E. And I encourage you to try this with larger and larger numbers, and you're going to get closer and closer to this magical mystery. You almost wouldn't mind paying the loan shark E dollars because it's such a beautiful number.
All right.
Here on your calculator, they have this e to the x. The calculator's precision is only goes so far.
Well, everyone, okay, that was absolutely beautiful. Did you just see what Salkan did there? He turned a boring loan shark story into one of the most elegant mathematical discoveries in history. My mind is completely blown right now, and I need to make sure you all understand what we just witnessed. So let me break this down, because this is seriously one of the coolest things in all of mathematics and finance. So I wanna break down like what the story Sal told us. So imagine you borrow $1 from a loan shark at, imagine like you borrow $1 from a loan shark at 100% interest for a year. Oh, sorry for my typo. I corrected it. I mean, shark. And for a year, normally you'd pay back $2, right? $2 pay back. Normally. So pretty straightforward, right? You borrow $1 at 100% interest rate for a year, and you will have to pay back $2. But then things get very interesting here. What if instead of charging 100% all at once at the end of the year, the loan shark splits it up? What do I mean by that? Let me explain. So it means 50% every 6 months, compounded twice. So that's 50% per 6 months. That's compounded twice. equals how much? That's $2.25, and about 8.33% every month, compounded 12 times. Compounded 12 times. So equals $2.61. A tiny bit every day. Compounded, how about like 365 times? Equals $2.7145 approximately, as he mentioned. So here's a mind-blowing part. You think that if you keep dividing the interest into smaller and smaller pieces and compounding more and more frequently, the amount will just explode to infinity, right? Do you think the amount would just explode to infinity? Like it would just keep getting bigger and bigger, bigger forever? But no, that's a real magic here. It actually approaches a specific number and stops growing. That number is called E, and it's approximately 2.71828 approximately. Think of it like this. Imagine you're trying to walk to a wall. First, you walk halfway there. Let me give you an example. You're trying to maybe walk to a wall, right? And first, you walk halfway there, and then you walk half of the remaining distance. Second, you walk half of the remaining distance, and then in the third time you walk half of the remaining distance again, and then the fourth time half again. And I will stop typing here, like maybe the fifth time and the sixth time and seventh time. You keep getting closer and closer to the wall, but you're taking smaller and smaller steps. You will never actually crash into the wall going infinitely fast. You will approach it smoothly. That's exactly what's happening with continuous compounding. As you compound more and more frequently, you get closer and closer to this magical number E, but you never go past it. Very interesting, right? So why is E so special, the number E? It is about 2.71828. It's called Euler number. And it shows up everywhere in nature and finance. For example, population growth follows patterns based on E, and the way disease is spread follows E. Radioactive decay uses E, and most importantly for us, continuous compound interest uses E. Maybe I will just type it down. Population growth and radioactive decay and the way diseases spread follows E. And most importantly, we're going to talk about continuous compound interest uses E. When we compound continuously, not yearly, not monthly, not daily, we literally every fraction of a second we use this number E. Now let me give you this formula pattern Saul showed us. He showed us this beautiful pattern. So let me show you this is what Saul typed when he was recording the video. The general formula is this one. And as n gets bigger and bigger, approaching the infinity, this gets closer and closer to E. So why does this matter for finance? Remember all those compound interest videos we watched on day 1 and day 2? Well, continuous compound is the ultimate form of compound interest. Some investments, some bond calculations, and some advanced financial models actually use continuous compounding with this number E. When you see formulas like this one, in finance textbooks, now you know what that E is. It's this beautiful number that represents the absolute maximum growth you can get from compounding. So the beautiful thing, what I love most about this is that it shows how mathematics has these natural limits and boundaries. Just because you compound more frequently doesn't mean you can make infinite money. There's a natural ceiling, and that ceiling is defined by this elegant number E. So even joked at the end that you almost wouldn't mind paying the loan shark E dollars because it's such a beautiful number. And honestly, after understanding where it comes from, I kind of agree. There's something really elegant about it. If you're sitting there thinking, this is so cool, math can actually be beautiful, then you're experiencing exactly what mathematicians feel when they discover these patterns. And if you want to keep experiencing these aha moments with us, make sure you're subscribed and join us every morning at 9 a.m. This is why I love the Khan Academy journey we're on together. We're not just memorizing formulas, we're understanding the deep, beautiful patterns that govern how money grows and how the financial world actually works. Alright everyone, are you ready to see how this magical number E gets used in real continuous compounding calculations? Because I have a feeling our next video are going to show us exactly that. Let's keep going. Alright everyone, we're about to dive even deeper into this mathematical rabbit hole, and I am genuinely excited about this. So let's read that Khan Academy tells us about this next video. E as a limit. This video continues the discussion on E, this time digging deeper into the mathematical definition of E. Now, in that last video, we discovered this beautiful number E equals 2.71828. Through that loan shark story, right? We saw how after you compound interest more and more frequently, every 6 months, every month, every day, you approach this magical limit of E. But here's what we're about to do now. We're going to look at the actual mathematical definition of E. We're going to see the formal, precise way that mathematical definition, how they define this number. Here's why this matters. In the last video, Saul showed us the E through a specific example, borrowing $1 at 100% interest. Right? What if it's not 100%? Does E still show up? This video is going to show us this next video is going to show us the pure mathematical heart of E, the definition that works for any situation, not just our loan shark example. We're going to see the formula that mathematicians use to define E as a limit. What does as a limit mean? E as a limit. Remember how we kept taking longer and remember how we kept taking larger and larger numbers, compounding 12 times, then 365 times, then we could imagine compounding 1,000,000 times, 1,000,000,000 times. And we kept getting closer and closer to E. That's called approaching a limit. The number E is that limit. E is that limit. So we're about to see the formula mathematical expression that captures this idea perfectly. It's going to look something like we saw before with that formula. This one. No. Where's the formula? Oh, here we go. But Saul is going to show us the rigorous mathematical way to express it. This is where finance meets pure mathematics, and it's absolutely beautiful. We're not just learning how to use E in calculations, we are understanding what E actually is as its core. Are you guys ready to see the mathematical definition that shows up in every calculus and finance textbook? Let's watch Khan review the formal definition of one of the most important numbers in all of the mathematics. Here we go.
In a previous video, when we were looking at a very simple case of compounding interest, we got the expression 1 plus 1 over n, 1 plus 1 over n to the nth power. And the way we got this, we saw an example where a loan shark is charging 100% interest, and that's where this one is. And then if they only compound once in the year, so it's 100% over the year, then n is 1. So you get 1 plus 100% over 1 to the first power. You're going to have to pay back twice the original amount of money. If n is 2, 1 plus 1/2 is 1.5. To the second power gets you 2.25. Is if you compound half the interest, so 100% over 2, but you compound it twice. And then we kept going and going and going. We saw interesting things happen. And I want to review that right over here using this calculator. I want to see what happens as we get larger and larger and larger n's. In that last video, we went as high as n is equal to 365, and it seemed to be approaching a magical number. But now let's go even further. So let's type in, and let's throw some really large numbers here. 1 plus 1 over, let's do 1,000,000. 1, 2, 3, 1, 2, 3. So that's 1,000,000 to the millionth power. 1, 2, 3, 1, 2, 3. Did I get the right numbers here? Yeah, that looks right. And before I even press enter, which is exciting, let's just think about what's going on here. This part that we have here is n gets larger and larger. It's getting closer and closer to 1, but never quite exactly 1. This is 1 and 1,000,000th. So it's very close to 1, but not exactly 1. And then we're going to raise that thing to the millionth power. And normally when you raise something to the millionth power, that's just going to be unbounded, just become some huge number. But there's a clue that, well, 1 to the millionth power would just be 1. And if we're getting really close to 1, well, maybe this won't just be some unbounded number. And when we calculate it, we see that that's the case. It's 2.71828 and it just keeps going. Now let's go even higher. Let's take it. Let's do 1 plus 1 over, and actually I can now use scientific notation. Let's say 1 times 10 to the 7th power. So that's literally, this right over here is 10 million to the 10 millionth power. So what do we get here? So now we went 2.718281692. Let's go even larger. So let's get our last entry here. So let's go, instead of the 7th power, let's go to the 8th power. So now we're 1 plus 1 over 100 million to the 100 millionth power. I don't even know if this calculator can handle this. And we get 2.71828181487. And you see that we are quickly approaching, or maybe not so quickly, we have to raise this to a very large power, to the number e. The number e in our calculator. You see we've already gotten 1, 2, 3, 4, 5, 6, 7 digits to the right of the decimal point by taking it to the 100th millionth power. So we are approaching this number. We are approaching. So one way to talk about it is we could say the limit as n approaches infinity, as n becomes larger and larger, it's not becoming unbounded. It's not going to infinity. It seems to be approaching this number, and we will call this number, magical and mystical number e. We'll call this number e, and we see from our calculator that this number, and these are almost as famous digits as the digits for pi. We're getting 2.7182818, and it just keeps going and going and going, never repeating. So it's an infinite string of digits, never repeating. Just like pi. Pi, you remember, is the ratio of the circumference to the diameter of the circle. E is another one of these crazy numbers that shows up in the universe. And in other videos on Khan Academy, we go into depth why this is so magical and mystical. Already this is kind of cool that I can take an infinite, if I just add 1 over a number to 1 and take it to that number, and I make that number larger and larger and larger, it's approaching this number. But what's even crazier about it is we'll see that this number, which you can view one way of it is coming out of this compound interest. That number, pi, the imaginary unit, which is defined as that imaginary unit squared is a -1, that they all fit together in this magical, mystical way, and we'll see that again in future videos. But just for the sake of E, what you could imagine what's happening here is going to our previous example of borrowing $1 and trying to charge 100% over a year. that when our n was 1, that means you're just charging over one period. When n is 2, you're charging over 2 periods, and then compounding, or you're compounding over 2 periods. When n is 3, compounding over 3 periods. When n approaches infinity, you could view it as you're continuously compounding every zillionth of a second. Every moment, you're compounding just a super small amount of interest, but you're doing it essentially you're approaching an infinite number of times, and you get to this number. Doing $1 and trying.
All right, everyone, that's incredible. Salkan just showed us the formula mathematical definition of E, and I need to make sure you all understand what just happened, because this is seriously beautiful mathematics. So what did we just watch? Saul took us on a journey with increasingly huge numbers. He started where we left off. Remember, we did that 1 plus 1. We did that 1 plus 1 divided by 365, all raised to the power of 365 for daily compounding. Well, he just cracked it up to extreme levels. He calculated this. Let me show you my notes. So for this one, one plus 1 over 1 million raised to the power of 1 million is about 2.71828. And 1 plus 1 over 10 million raised to 10 million is roughly 2.718281692. 1 plus 1 over 100 million raised to 100 million comes out to about 2.71828181487. As we increased n, the expression 1 plus 1 over n to the power of n gets closer and closer to E. You can see how the numbers converge from the 2.71828 to 2.718281692, and then 2.71828181487, getting more precise the bigger n gets. Did you see what's happening? As we make n bigger and bigger, 1 million, 10 billion, 100 million, we are getting more and more precise digits of E. We're getting closer and closer to that magical number. 2.1782818 blah blah blah. The official mathematical definition, here's the beautiful part. Mathematicians write this as this. E equals the limit as n approaches infinitely of open parenthesis 1 plus 1 over n close parenthesis raised to the power of n. E is the number you get when you take 1 plus 1 divided by n, raise it to the power of n, and let n grow bigger and bigger all the way to infinity. Let me translate that into plain English to human language. If you take the expression, this one, and make n bigger and bigger and bigger toward infinity, you will get closer and closer and closer to E. Alright? So why is this so mind-blowing? Think about what's happening here. You're taking a number that's getting really close to 1, like a 1.0000001 or even closer, and you're raising it to a massive power like the millionth power. Normally, when you raise something to a huge power, it either explodes to infinity or shrinks to nothing. But because this number is so close to 1, and because of the special relationship between the base and exponent, it settles perfectly at E, 2.71828. It's like a mathematical balancing act. The closer the base gets to 1, the higher the power gets, and these two forces balance each other perfectly to give us E. So what does this mean for finance? Do you remember our compound interest journey? This formal definition tells us that when we compound continuously, not just daily, not just every second, but literally at every moment, we use this number E. This is what continuous compounding means in finance. When you see formulas like this in your finance textbooks, that E comes from this exact limit definition. Such beautiful connection. At the end, Sal mentioned something absolutely mind-blowing. This number E, which comes from compound interest, is connected to pi. The circle number, remember we talked about 3.14, and I, the imaginary unit in this magical equation called Euler identity. It's considered the most beautiful equation in all of the mathematics. But we will save that for another day. Today, just appreciate that we've discovered one of the most fundamental constants in the universe through the simple question, what happens when we compound interest continuously? And here's a big picture. N approaches infinity, continuous compounding, and you get E. This number E equals approximately equals to 2.7182818. Yes, here we go. This E shows up everywhere, not just in finance, but in biology, population growth. We mentioned that before, population growth and biology and physics, right? This is the physics. The radioactive decay and also the probability. And countless other fields, a lot of other fields. It's truly one of the most important numbers in mathematics. If you're sitting there thinking, wow, I actually understood a formal mathematical definition and it was beautiful, then you're experiencing exactly why people fall in love with mathematics. And if you want to keep having these mind-expanding moments with us every morning at 9 a.m., make sure you're subscribed. This is why our Khan Academy journey is so valuable, everyone. We're not just learning formulas to pass a test. We're understanding the deep, elegant mathematical truths that govern our financial world and the entire universe. Alright, are you guys ready to see how we actually use this number E in real continuous compounding calculations? Because I have a feeling that's exactly where we're headed next. Let's keep this incredible learning momentum going. And let's check out this one. Formula for continuously compounding interest. Alright everyone, we've reached a really exciting point in our journey. Let's read what Khan Academy tells us about this next video. Compound interest is when interest is added to the principal, so the interest also earns interest. Oh, that's really cool. And continuous compounding is a special case where interest is added an infinite number of times per year, making the growth smoother and faster. Learn how to use formulas to calculate compound interest and continuous compounding. This is where everything comes together. We've been building up to this moment through our entire learning journey. So here's what we've learned so far. On day one, we learn about the compound interest basics. How your money grows when interest earns interest. We discovered the rule of 72 and saw how powerful compounding can be over time. Then we learned about simple versus compound interest and saw the mathematical formulas behind them. Just now, in these last two videos, we discovered this magical number E equals 2.71828 and so on. This E, that's approximately E, Euler's number, which goes on forever without repeating, and learn that it represents the limit of compounding as you compound more and more frequently, approaching infinite times per year. Now we're about to learn the formula. This video is going to show us the actual formula for continuous compounding, the one you will see in finance textbooks, investment calculations, and real-world applications. Up until now, we've been exploring the theory and discovering where E comes from. But now Sal is going to give us a practical tool, the formula that lets you calculate exactly how much money you will have while interest compounds continuously. Exciting? This is the difference between understanding the concept and being able to actually use it. We're about to get the mathematical tool that let us calculate continuous compound interest for any principal amount, any interest rate, and any time period. Think about it, we now understand that continuous compounding means compounding every infinite moment, and we know it involves that magical number E. Now we're going to see how to actually calculate it. This is super practical stuff, folks. This formula shows up in the advanced investment calculations, as we talked earlier. Investment returns, the bond pricing models, options pricing, banking calculations, and so many other real-world financial applications. If you've been following along with us from day one, you're going to absolutely love how everything connects. All those concepts we learned, compound interest, the number E, they're all about to come together in one beautiful practical formula. Let's watch Saul Khan give us the tool to actually calculate continuous compound interest. This is going to be powerful. Here we go.
Let's say that we're looking to borrow $50, so we can say that our principal is $50. We're going to borrow it for 3 years. So our time, let's say T in years, is 3. And let's say we're not going to just compound per year. We're going to compound 4 times a year, or every 3 months. And let's say that our interest rate, if we were only compound once per year, it would be 10%. But since we're going to compound 4 times a year, we're going to see in an expression, we're going to divide this by 4 to see how much we compound each period. So 10% is the same thing as 0.10. So let's write an expression. I encourage you actually to pause this video and try to write an expression for the amount that you would have to pay back if you were to do this. If you were to borrow $50 over 3 years, compounding 4 times a year, each period you would be compounding 10% divided by 4%. How much would you have to pay back in 3 years? Let's write it out. $50, that's your principal, and you're going to multiply that. You're going to multiply that, so you're going to, or I should say you could compound it. Each time, each period, each of these 3 times 4 periods, you have 3 years, each of them divided into 4 sections. So you're going to have 12 periods. So each of them you're going to compound by 1 plus this R, so I'll write that as a decimal, 0.10 divided by the number of times you're compounding per year to the, well, you'd be raising it to the nth power if this was only over a year. So there's 4 periods, and you'd raise it to the 4th power if it was only a year. But this is 3 years. So you're going to be doing this 3 times 4. You're going to have 4 periods 3 times. So let me write this. So it's going to be 4. Actually, let me write, instead of n right over here, let me write the 4 so you see all the numbers. So you're going to do this 4 times 3 to the 4 times 3 power. And we could even, well, I encourage you, if you want, you could pause the video and you can use your calculator to actually calculate what that is. But the whole point of this is just to use real numbers to see why this actually makes sense. This is your principal. Each time you're going to be multiplying that times 1.025, or you're going to be growing it by 2.5%, and you're going to do this 12 times because there's 12 periods, 4 periods per year times 3 years. So this is going to be how much you have to pay back. So if we wanted to write this in a little bit more abstract terms, we could write this as P times 1 plus, and I'll do the close parentheses since it's the same color, R over n to the n times t power. And so you could pick your p, your t's, your n's, and your r, and you could put it here, and that's essentially how much you're going to have to pay back. Now, an interesting thing, and you saw that we had this up here from a previous video where we took the limit as n approaches infinity. Well, let's do the same thing here. Let's think about what that would mean. If we took the limit as n approaches infinity, if we took the limit of this as n approaches infinity, what is this conceptually? Well, we're dividing our year into more and more and more chunks, an infinite number of chunks. So you could really say, well, this would be the case where we're doing continuous compound interest, which is a fascinating concept to me. You are just
Alright guys, let's pause the video a little real quick. I'm gonna talk about this real quick. So, hey folks, we just watched a part of the video, and Silicon gave us the formula, the actual practical tool for calculating continuous compound interest. This is what everything has been building up to, and I need to make sure you all understand this because it's absolutely helpful. So I want to pause it just to focus for a second. So what did Sal just show us? He started with a regular compound interest example, borrowing $50 for 3 years at 10% interest, compounded 4 times per year, quarterly. Let me type this down. For example, this is an example from the video. Borrow $50 for 3 years at 10% interest, compounded 4 times. Compounded 4 times a year. And quarterly. All right. And also, he showed us the formula. This is a formula. The total amount equals the principal P multiplied by 1 plus the interest rate divided by n, all raised to the power of n times t. So here, let me explain this. As you can see, P stands for the principal, which is $50 in our example. R is the annual interest rate. Here it's 0.1 or 10%. N is the number of times the interest is compounded in a year, so that's 4 times. And T is the time in years, which we're setting as 3. This is the standard compound interest formula we've been working with. All right, let me type it out. Standard compound interest formula. Now let's keep watching this video together.
You're dividing your time period in an infinite number of chunks and then compounding just an infinitely small extra amount every one of those periods, but you can actually come up with an expression for that. And as we see that this actually doesn't just go unbounded and give us crazy things, that we can actually use this to come up with a formula for continuously compounding interest, which is used heavily in finance and banking and as you can imagine, a bunch of things, and actually things, many things outside of finance and banking, exponential growth, etc., etc. So let's see if we can actually try to evaluate this thing right over here. Well, the one thing I am going to do to simplify this is to do a substitution. So I'm going to define a variable. I'm going to define, the whole goal is so I can get it into a form that looks something like this. I'm going to define a variable x. And I'm going to say that x is the reciprocal of r over n, so that I can get a 1 over x right over here. So I'll write that as n over r. X is equal to n over r, or we could write this as n is equal to x times r. N is equal to x times r. And if we make that substitution, the limit as n approaches infinity, well, if we take the limit as x approaches infinity, then n is going to go to infinity as well. Or if n goes to infinity, then x is going to go to infinity as well. R right over here is just a constant term. We're just assuming that that's a given, that n is what we're really seeing what happens as we change it. So we could rewrite this thing right over here. And I'm not being as super rigorous, but it's really to give you an intuition for where the formula we're about to see comes from. Let's rewrite this as the limit as x approaches infinity. The limit as x approaches infinity. And the limit of some constant times some expression, well, we could take the constant out. So we could say that's going to be p times the limit as x approaches infinity of 1 plus, well, r over n is 1 over x. 1 plus 1 over x to the, well, n is x times r. N is x times r, so let me write that, to the x times r times t power. Well, all of this business is the exact same thing. So let me rewrite this. Let me copy and paste this part right over here. So copy, this is the same thing. This is equal to p times, let me put some parentheses here, times, maybe that's too big, times the limit, so this limit right over here. So if I raise something to the product of these, I'm taking x times r times t, well, that's the same thing as doing this whole thing to the x and then raising that to the RT power. RT power. This comes from exponent properties that you might have learned before. These two things are equivalent. I'm doing a couple of steps in the process here, but hopefully this seems really reasonably intuitive for you. I'm really just using the property that the limit as, let's say, x approaches c of f of x to the, let's call it, to the xrt power. This is the same thing as the limit as x approaches c of f of x to the x, and then all of that raised to the rt power. Well, what is this stuff right over here? What is all of this business that's inside the parentheses? Well, we've seen that before. All of this, all of that is equal to E. So we can write this, and this is exciting. This is a formula for continuous compounding interest. That if we continuously compound, we're going to have to pay back our principal times E to the RT power. To the RT power. So let's do a concrete example here. If you were to borrow $50 over 3 years, 10% interest, but you're not compounding just 4 times a year. You're going to compound an infinite times per year. You're going to be continuous compounding. So we can see how much you would actually have to pay back. It is going to be 50 times E to the, our rate is 0.1. So let me put some parentheses here. 0.1 times time. So times 3 years. T is in years. We assumed it was in years. And we get, you would have to pay back $67. And if we were to round, $67.49 if you were to round. Interest, but you're not, times E infinite time.
All right, everyone. Then continue with where we just left. Then something amazing just happened. So asked us, what if we compound not 4 times a year, not 4 times a year, not 365 times a year, but infinitely many times per year? What happens when n approaches infinity? And through some clever mathematical substitution, he used this formula to rearrange things. He showed us that when n approaches infinity, that whole complicated expression simplifies to something beautifully elegant. The total amount equals the principal P multiplied by E to the power of R times T, where E is that special number we just mentioned, about 2.718. What's this? Let me tell you, this is the continuous compounding formula. Yes, it is. I hope I wrote it clearly. Or they are the same thing. A equals PE to the power of R times T. The amount A equals the principal P multiplied by E raised to the power of R times T, where E is Euler's number, about 2.718. Now, the P, let me just type it out. P is the P is the principal amount, the money you start with. All right. E equals that magical number. E is that special constant about 2.718, and so on. And R, what's the meaning of R? R equals annual interest rate. R is the annual interest rate written as a decimal. And how about the T? What's the meaning of T? T is the time in years. So let's see let's see it in action. So then calculate the concrete example. If you borrow $50 at 10% interest for 3 years with continuous compounding. Let's talk about the example from the video. So if you borrow $50 at a 10% interest for 3 years with continuous compounding, how to calculate that with this formula? So it should be like this. Let's plug in the numbers into the formula. Our formula A equals 50 times e to power of 0.1 times 3. That's the same as 50 times e to the power of 0.3. Now e to the power of 0.3 is about 1.3498. So we multiply 50 by 1.3498, which gives about $67.49. So $67.49. So you'd have to pay back this amount of money. So let's talk about why is this formula so beautiful. Look at how clean it is. Instead of that messy 1 plus the interest rate divided by n, I'm talking about this formula. Instead of this one, all raised to the power of n times t formula with division and multiple exponents. Continuous compounding gives this one, this elegant. The total amount equals the principal p multiplied by the e raised to the power of r times t, where the e is Euler's number, approximately 2.718. That's the power of that number e. It simplifies everything when you're dealing with continuous growth. Now, what does continuous compounding really mean? Think about it like this way. Daily compounding. Interest added 365 times per year. And hourly compounding. Interest added 8,760 times per year, and every second interest added 31,536,000 times per year, and continuous interest added at every moment, literally infinite times per year. It's like your money is growing smoothly and constantly, not in little jumps, but in one continuous flow. That's why Saul said it makes the growth smoother and faster. In the real world, And so give us some examples. He mentioned that this formula is used heavily in finance and banking. Some bonds use continuous compounding in their calculations. Where it is? Yeah, here we go. In finance. We're talking about the real world application. And options pricing models like and investing growth projections and present value calculations and tons of applications outside finance. We talk about the population right here, and radioactive decay, anything that grows exponentially. Exponentially. Anything that grows exponentially. Guys, remember our journey day one? We learned about a compound interest grows your money. We discovered the rule of 72, and we learned the formulas for regular compound interest. We discovered the magical number E through that limit, and now we have the ultimate formula that uses E for continuous compounding. Everything connects, right? That number E that seemed so abstract and theoretical, it's actually the key to the most elegant formula in compound interest. Alright everyone, what an absolutely incredible session we just had. We just completed lesson 4. Continuous compound interest and APR, and honestly this might have been one of the most mathematically beautiful sessions we've covered so far. Let me take a moment to recap what we just discovered together. Our journey through the lesson through the lesson 4, we started. Where did we start? We started by discovering the magical number E equals 2.71828. Through that fascinating loan shark story, we saw how compounding more and more frequently every 6 months, every month, every day, every second doesn't explode to infinity, but instead approaches this elegant mathematical constant. Then we dove deeper into the formal definition of E as a limit. We watched the cell calculate the 1 plus 1 divided by n, all raised to the power of n, for increasingly massive values of n, a million, 10 million, 100 million, and so how it gets closer and closer to E. We learned that the mathematicians define E as the limit of this expression as n approaches infinity. Finally, we got the practical payoff, the actual formula for continuous compound interest. Right? This one, or this one. This beautiful, elegant formula shows us how to calculate growth when interest compounds at every moment. We even worked through a real example. Borrowing $50 at 10% for 3 years gives you $67.49 with continuous compounding. What makes this session so special is that this section connected pure mathematics with practical finance in the most elegant way. The number E isn't just some abstract concept. No, it's a key to understanding the absolute maximum growth you can get from compound interest. It's a mathematical limit of compounding, and it shows up in investment calculations, bond pricing, options models, and countless other real-world applications we talked about. So looking at our Khan Academy dashboard, we still have more incredible content ahead in Unit 1, present value, personal bankruptcy, and more. And remember, Unit 1 is just one of the 10 units in this finance and capital markets course. If today's session opened your mind to the beauty of mathematical finance, please hit that like button. And if you want to continue this journey with us, learning the fundamentals that will make you smarter investor and consumer, make sure you are subscribed and have that notifications bell on. Join me tomorrow morning at 9 a.m. Eastern Time for day 4 of our financial education series. We'll continue exploring Khan Academy, and I will also be sharing what's happening in the markets and breaking down any important economic news. And if you have any questions, just click the link in the chat, the pinned link, which is our WhatsApp group, and you can reach me out directly. And also, please remember, drop a comment and let me know, what was your biggest takeaway from today? Was it discovering the number E, understanding the limit definition, or finally seeing that beautiful continuous compounding formula? Remember, every successful investor and financial professional started exactly where you are and where I am, where we are right now, learning these fundamentals. By showing up here every day and putting in the work to truly understand these concepts, you are building a foundation that will serve you for decades to come. So guys, I will see you tomorrow morning at 9 a.m. sharp. Until then, keep thinking about that magical number E and how it represents the ultimate power of compound interest. Take care, everyone. Take care, everyone, and I will catch you in the next stream. Thank you so much for hanging out.